If you've ever toyed with the idea of acquiring a cash flowing car wash business with none of your own money, you'd be an absolute moron to skip this video because we're going to go deep on every layer of the funding stack and the SBA down payment number absolutely nobody tells you about. If you're looking to buy in a car wash, here's the number nobody tells you up front. An SBA loan will fund 80 to 90% of that deal. The other 10 to 20% is on you. So most buyers have no idea how big that number actually is until they're sitting across from a lender. So SBA funds 80 to 90%, 10 to 20% is on you. This is your equity injection out of pocket if you don't know the capital stack. And then typical deal size, these can run into the seven figures. So let's get fair up it and look at the specifics. Why car washes get priced differently? So car washes are treated differently from almost any other business purchase. The SBA classifies them as a special purpose real estate. So the same bucket as a gas station or a bowling alley, because the property is hard to repurpose for anything else. That single classification changes almost every number in your loan, your down payment requirement, your lender's risk appetite, and the terms you can expect at the table. So special purpose real estate for things like car washes, gas stations, bowling alleys, that's the classification. And the reason that matters is this classification triggers stricter equity injection requirements and changes nearly every loan term you'll negotiate. There's a few different types of SBA loans, so here's one that actually fits. The loan program is almost always the SBA 7A, up to 5 million, covering the purchase price, real estate equipment, and working capital, all in one loan. And according to Think SBA, the SBA guarantees up to 85% of it, and the lender funds the rest. So if the deal is real estate heavy, a 504 loan is often paired alongside the 7A specifically for the property itself. Your 7A is going to be up to 5 million. SBA 504 paired alongside for real estate heavy deals targets the property underlying the business. And then you got that 85% guarantee as of the timing of this video. So your real down payment number. Here's where it gets expensive. So standard SBA equity injections, 10% of total project costs. But because a car wash is special purpose real estate, most lenders push that to 15 to 20%, and some acquisition deals reach 30% depending on your risk profile. So let's look at an example of a $1 million car wash. 20% injection would be $200K in cash before the lender funds a single cent. Now, what lenders actually check? Here's a key. This is how you're going to put yourself in position for this to run smoothly. So qualifying for a 7A loan means clearing several specific hurdles. According to Bay Street Lending, most lenders want a 680 or higher FICO. As of March this year, SBA requires a debt service coverage ratio of 1.1. If you're aware of how a DSCR works, that just means that your income from the business, based on the last 2 years of history, operating track record, are going to cover the loan at 1.1 times the repayments. So lenders also want at least 2 years of operating history on the business you're buying to actually average that number out. You won't get declined solely for lacking collateral, but if you have it, lenders can and will require it. So the requirement nobody will mention or tell you about, here's the one almost nobody talks about: post-close liquidity. So according to Go SBA loans, most lenders want 5 to 10% of total project costs sitting in your personal account, accessible after closing. What this isn't, it's not your down payment, working capital inside the loan, a line of credit you can draw later. It's 5 to 10% of total project costs sitting in personal accounts, accessible immediately after close, and proof you can survive the first few rocky months. The mistake that kills these approvals: you can't use an unsecured personal loan to cover your SBA down payment. SBA treats that as financing one loan with another, and lenders check for it. According to Port 51, funds need to be seasoned in your account for 60 days or more before closing, with a clear paper trail back to their source. This is one of the most common mistakes buyers make, and it's one of the fastest ways to lose an approval you thought had locked up. So what kills it? Using an unsecured personal loan as your equity injection. SBA flags this as financing one loan with another. And what we actually want to do is fund season 60 plus days in your account with a documented paper trail back to their origin. Now, here's the key: where a real funding stack actually works and the sequencing involved. So where does a real gap funding stack actually help? not by handing you borrowed cash to fake your way through underwriting, by fixing the two real problems before you ever walk into an SBA lender. So problem one, if you're drowning in credit card debt, the fastest way to increase your FICO would be to use debt consolidation to put yourself in a better position there. Then gap funding, structured stack to bridge qualification gaps, and then qualified borrower with clean funds. How do we do that? So step one, clean up before you apply. Before you apply, debt consolidation drops your revolving utilization and can move your score 40 to 80 points in a single reporting cycle. And that is the difference between qualifying at the 680 threshold or getting knocked back on personal cash flow review. So the action, consolidate revolving debt before applying to reduce utilization ratio. The result, FICO improvement of 40 to 80 points in a single reporting cycle. So that'll be under 30 days. And then the margin between qualifying at 680 and getting declined on cash flow review. Now, here's the down payment source SBA actually does allow. So a HELOC is the one tool SBA actually sanctions as a legitimate equity injection source. If you have income outside the business you're buying to cover the new payment, a HELOC draw against home or investment property equity can become the season cash your down payment needs to be. So SBA sanctioned HELOC is explicitly approved by SBA as a legitimate equity injection source. The key requirement is you must have outside income to cover the HELOC payment, not from the business being purchased. And the outcome is properly seasoned funds that satisfy lender requirements and clear underwriting. So at this stage, we've got the seasoned funds, we're into the deal. Now we're building the reserve. So rapid gap funding and 0% credit card stacking do not touch your down payment. Their job is building the post-close liquidity cushion and the working capital reserve lenders want to see. So top of what SBA loan itself funds, that is the buffer that gets you through the slow months, equipment repairs, and payroll before the wash is cash flowing on its own. So rapid gap funding builds the post-close liquidity cushion. Lenders require to see in your personal accounts after closing. 0% credit card stacking builds the working capital reserve on top of the SBA loan funds. And that's your operational safety net to get you through. Now, step 4 is your operating cushion. Once the wash has its own financials, you can actually go and pull a business line of credit, which becomes your ongoing operating cushion after the SBA loan closes. So revolving, interest only on what you draw just for that first year. It's revolving. Many of them are interest only in the first year and available when you need it, invisible when you don't. SBA loan closes, business is acquired and operating. Step 2, financials established. The wash builds its own track record. And then you've got a line of credit open. Revolving interest only operating cushion activated. So let's look at the 60 to 90 day timeline here of this whole process. And here's the part that actually matters, timing. Seasoning rules mean funds need 60 days or more in your account before closing. Credit repair needs at least one reporting cycle to show up. The real move is starting the stack 60 to 90 days before you ever sit down with an SBA lender. So day 1, debt consolidation and HELOC initiated. Credit repair and seasoning clock starts. Reserve building in parallel, 30 to 60 days. Gap funding and credit stacking deployed. Day 60 to 90, funds season, FICO improved, liquidity cushion built. Sit down with your SBA lender. So you've applied in the right order so nothing knocks your approval back. Now, what the SBA covers and what you cover. SBA funds 80 to 90% of the purchase price, real estate and equipment, working capital inside the loan up to $5 million. And you handle the 10 to 30% equity injection in seasoned cash, 680 FICO before you apply, 5 to 10% post-close liquidity reserve, and 90 days of financial discipline before the meeting. So an SBA loan will fund most of a car wash. It will not fund the discipline of getting your own financial house in order 90 days before you need it. That part's on you, and it's exactly what this stack's built for. So get it organized months out. So let's map your deal. You now know the number nobody tells you. You know why car washes are classified differently and what lenders actually check, and the exact 60 to 90 day stack that gets you to the table qualified. So the next step is yours. Head to gapfunder.com/apply. Let's map out what this looks like for your specific situation, your deal size, your credit profile, and your timeline. Links in the description below. I'm Mick Wadley. Let's go close something.